Howdy, y'all, and welcome back. This is the weekly economic update for August 30th, 2021. I hope everyone had a fantastic weekend. Apologize for not getting a video out on Friday. My older boy was here in town and just got busy, didn't get a chance to do a recording. So we'll catch up on a couple of those things that I normally cover on Fridays and go through the weekly update. It's been a beautiful few days here in Colorado. We do have a little bit of smoke in the air, which is burning the eyes. I think some of it's coming from a fire a few counties are over, but all in all, pretty nice. Starting to cool off in the evenings, and it's the weather's always nice here, even when it snows. So, all right, well, let's go ahead and jump into the weekly update. Make that a little larger so you can read it. So, all right, the week on Wall Street. The stock market powered to record levels last week amid talks of Fed tapering and deceleration in new Delta variant cases. The Dow Jones average gained 0.96. The S&P increased to up 1.52. NASDAQ picked up 2.82, and the international rose 1.39%. So looks like across the board, everything did pretty well, all things considered. Pushing higher, stock surged to begin the week as investor sentiment improved on the news that the FDA's approval of its first COVID-19 vaccine, a strong housing number, and comments from the Federal Reserve Bank Dallas president that he would support delaying tapering if the Delta variant spread worsened. Stocks continued to climb through midweek, pushing the S&P 500 to another record high and the NASDAQ composite above 15,000 for the first time. The S&P 500 and NASDAQ closed the week at record highs following Chair Powell's comments that the Fed is likely to begin winding down its monthly bond purchases, aka tapering, by end of year, though no interest rate hikes were imminent. Next paragraph, Powell speaks at last week's Jackson Hole Economic Policy Symposium. Fed Chair Jerome Powell's speech on Friday provided further insights into Fed plans to begin tapering. Powell said that the Fed may likely commence tapering prior to year end, adding that the wind down of bond purchases should not be seen as a signal of future rate hikes. Powell emphasized that the labor market conditions remain short of the Fed's target for maximizing employment. He also reiterated his case for why inflation remains a transitory phenomenon with a number of regional Federal Reserve Bank presidents already supportive of tapering. Investors see more definitive steps coming out of next month's FOMC meeting. So we'll see. I know I've been bitching and moaning that we need to stop doing this. It's creating it's just really a false market. When the government's propping up the investment markets, it leads to the inflation we're seeing. It leads to potentially a bubble that could pop. Remember 2008 and 9, huh? So we'll see. I imagine that at a moment's notice they'll go back to buying bonds and flooding the market with cash. So, all right, the week ahead in economic data. Tuesday, tomorrow, we have consumer confidence. Wednesday, we have the ISM, which is the Institute for Supply Management Manufacturing Index, the ADP employment report on Wednesday also. Thursday, we have jobless claims and factory orders. And Friday, employment situation report and the ISM services index. A couple companies reporting earnings this week. Today, we have Zoom. Tomorrow is NetEase and CrowdStrike. And Wednesday, it's Okta. Never heard of them. And next page, Thursday, we have Broadcom, Mongob, and DocuSign. All right. Well, that's everything there. Had one white paper going out this week. It's titled 401k Millionaires. What does this mean for your overall retirement strategy? Let me go ahead and read through this. Your workplace retirement account can play a critical role in your overall retirement strategy. However, some have gone further with accounts than others, especially recently. CNBC reported on findings that 401k accounts at an all-time high, with some even joining the much-desired 2 Comma Club of 401k millionaires. Average 401k balances jumped 24% from the previous year to $129,300. Also on the rise were overall contributions, with 12% increasing their contributions since last year, and 37% of employers placing new employees into workplace plans. It's good people are saving. The study discovered a record 412,000 401k plans with $1 million balances. Overall, individual retirement account millionaires reached 342,000, another record. Some of this represents a correction from 2020, as well as the economic uncertainty faced during the early days of the global pandemic. People are rethinking their retirement needs and taking advantage of employer matches if available. It also reflects businesses working to entice employees. Even some restaurants are offering 401k plans to their workers these days in a bid to maintain staffing levels year-round. What does this mean for your overall retirement strategy? I'd be happy to talk about you. Blah, blah, blah. All right. Well, I guess that's some good news. 401k and IRA balances continue to rise. Granted, a lot of that is due to the inflation in the stock market. We're seeing prices go up. The values of securities are going up, because there's just so much cash in the economy. So we'll see once all this, once it all shakes out. And I guess my dog isn't real excited about hearing about that, but pardon the noise. All right, let's go over to the information I normally cover on Fridays. Jobless claims last week came in over forecast, 353,000 against a forecast of 350. So just barely. Nothing dramatic. The previous week's numbers were revised up 1,000 from 348 to 349. Again, the trend is still positive. This trend line is still going down, which is definitely a good thing. All right, continuing jobless claims came in at 2,862,000. The forecast was 2.79, so about 70,000 over the forecast. Last week's numbers were revised up from 2.82 million to 2.865 million. Again, both of those, the last 2 weeks have been above forecast, whereas the previous 2 weeks, they were under forecast. So, but all in all, again, this trend line is still heading in a good direction. But if we remember from previous videos, we're looking to get this number down to about 1,600,000, 1,700,000. That was the trend before. And so we're still about 100%, close to 100% higher today versus where we were in January and February of 2020. So still a lot of improvement there. And if I go back to the initial jobless claims, typical jobless claims numbers were 200,000-ish. And we're still at, 350,000. So that's about 75% more than what we would consider a normal period. So, but all in all, things are good. I know I'm still seeing a lot of restaurants that out and about that are, it's open, but they're not able to seat all the tables, assuming that they don't have enough wait staff to cover the flow of business that comes through in any given day. So we're getting there, but who knows when things are going to fall apart again. So, all right. So there were a couple things I wanted to go through. These were from First Trust. The first one is July personal income and consumption. Personal income rose 1.1% in July, 1.2% including revisions to prior months, easily beating the consensus expected of plus 0.03. Personal consumption rose 0.3 in July, 0.4 including the prior month's revisions versus a consensus expected of 0.4. So it came in a little bit under. Personal income is up 2.7% in the last year, while spending has increased 12.1%. Okay. Disposable income, income after taxes, rose 1.1% in July and is up 0.5% from a year ago. This is kind of the bad news right here. The overall PCE deflator, consumer prices rose 0.4 in July and is up 4.2% versus a year ago. And the core PCE deflator, which excludes food and energy, rose 0.3 in July and is up 3.6 in the last year. So if personal income is up 2.7% and prices are up 4.2 and 3.6 respectively, you're still underwater. So, costs, things are more expensive right now than income is keeping up with. And then the last bullet point, after adjusting for inflation, real consumption declined 0.1 in July, but is up 7.6 from a year ago. So it's kind of a mixed bag. It is always good when income goes up, but when it's not keeping up with consumption prices, you're still losing some ground. All right. And then the last one is an article for Brian Westbury, chief economist at First Trust, one of my favorite guys to listen to. It's titled 5,000, and I'm just going to read a couple paragraphs out of here, and then we'll wrap up. Starts out, we've been consistently bullish on stocks since 2009. This bullishness has paid off, although not every year. Stocks fell in 2015 and 2018, but since 2009, the market has rebounded from every correction. Why have we stayed so bullish, or why have we stayed bullish? Because our capitalized profit model has consistently shown that the S&P 500 is undervalued since 2009. It still shows this today. In the past 12 months, we've set forecasts for the end of each year. When the market corrected, we often just reiterated the call for next year. But in a few cases, we ended up raising our forecast during the year. For 2021, we set our year-end forecast for 4,200 for the S&P 500. By mid-April, however, the stock market was already flirting with 4,200, and as a result, we raised our forecast to 4,500. Now, once again, the stock market has outpaced our bullishness, surpassing 4,500, but that's not our only important information we got back last week. We also got economy-wide corporate profits for Q2 that were outstanding, up 9.2% from Q1 and up 15.8% from the pre-COVID peak in late 2019. These figures let us update the capitalized profit models. As many of you know, we think the current 10-year yield of 1.3 is being held artificially low by the Federal Reserve. As a result, we've discounted current profits using a more cautious rate of 2%. Plugging that rate into the model with superb Q2 profits generates a fair value estimate of for the S&P 500 of 6,133. How robust is this fair value estimate? Well, if corporate profits fell 36% and the 10-year was 2%, the market would be at fair value today at roughly 4,500. The same result would occur if the 10-year yield more than doubled to 2.7%. In other words, the market is rising for a reason, profits are up, and the threat of higher interest rates remains low. As a result, we think it is prudent to raise our 2021 year-end forecast to 5,000 on the S&P 500. So, I mean, they go through, why they think that the S&P 500 is going to continue to climb up to a range of around 5,000 by the end of the year. Let's see here. There are some obvious risks to this forecast. Number one, the U.S. could lock down the economy again over the Delta variant of COVID. The Fed could raise rates more quickly. President Biden and the Democrats could push through major tax hikes. Rightly or wrongly, we don't think the U.S. will lock down again. I don't think so either. I think this will probably be behind us by April of next year, based upon some of the things I've read on the internet. That's when things will just disappear. So you can hold me to that. You can come back to this broadcast and say, "Hey, Ray, you said this." All right. Rightly or wrongly, we don't think the U.S. will lock down again. I already read that. At the same time, last week's Jackson Hole speech by the Fed Chairman Jerome Powell made it clear that monetary policy is likely to remain very loose for the foreseeable future. The Fed may start to taper, but it will do so slowly, primarily because it thinks inflationary pressures are temporary. Also, the Fed views Delta as a risk to economic growth. Yes, we are very fully aware that tax rates are likely to go up if Congress can pass an all-Democrat budget bill, but we think that the kinds of tax hikes that are likely to pass are already priced in, including a top regular income tax of 39.6 versus 37, a corporate tax near 25% versus 21, top capital gains and dividends tax of 24% versus 20% right now, and Biden's proposed 39.6. And they say that we don't think they have the votes to end the step up in basis at death. The bull market in stocks will eventually come to an end and some sort of correction is overdue, but we think that the general trend remains up and optimistic investors will be rewarded. So, and I would agree. Until we start to see some personally, I think that we'll see a change in interest rates before we'll get to before we'll really see a decline in the market. But I could be wrong. There could be some other event. We just had 13 service members die in Afghanistan last week. Whether or not that's going to lead us to go back over there when we really shouldn't be, who knows? But anyways, all right, let's go ahead and wrap things there, and we'll go ahead and I promise we'll have a video on Friday. I don't have any family members in town. And if you got any friends or family over in Louisiana, go check on them. I've checked on my buddy Kevin. He's doing okay. And but if let's keep them in our thoughts. And I'll talk to everyone on Friday. Have a great week. Bye-bye.